All right, so welcome to the deep dive. Today we are going
Wow.
deep, deep into the world of hedge funds.
Ooh, exciting.
It is exciting.
Yeah.
We're using two YouTube lectures from finance professor Patrick Boyle,
Uh-huh.
and it's called Applied Portfolio Management. And this is Class 7, Hedge Fund Strategies, How Hedge Funds Invest. And then there's a second part of the class, which we'll also be referencing, which is Applied Portfolio Management Hedge Funds Part 2, How Hedge Funds Invest, Trading Strategies.
So we're going to get into all the nitty-gritty of it.
We are going to get into the nitty-gritty.
Nice.
And just as a little teaser, did you know that hedge funds got their name from a guy who literally hedged his bets like an old-time sea captain? So he was diversifying
Like,
his
yeah.
investments
Yeah.
to weather any financial storm.
I actually didn't know that. That's a cool little historical tidbit.
I know. I thought it was pretty cool.
Yeah.
And then we're also going to talk about how a hedge fund manager actually brought the Bank of England to its knees.
Wow. Okay, so high stakes.
High stakes.
We're going there.
So before we get too far into those crazy stories, maybe we should start with the basics, huh?
Yeah, let's lay the foundation. What exactly IR a hedge fund? I mean, people throw that term around, but what does it really mean?
It gets thrown around a lot.
It does, and I
Yeah.
think there's a lot of mystique and misunderstanding surrounding it.
Yeah, like what is it?
Well, at its simplest, a hedge fund is an investment partnership.
Mm.
But it's a bit more exclusive, a bit more, dare I say, elite than your average mutual fund.
Okay.
They're not just trying to beat the market. They're aiming for what we call alpha.
Alpha.
Yes, alpha. Think of it as returns that are completely independent of how the overall market performs. They're looking for those hidden gems, those unique strategies that can make money whether the market is up, down, or sideways.
Got it. So that's why you see these big institutions like university endowments and pension funds pouring money into them. They're not just chasing returns. They're looking for that extra layer of diversification.
Absolutely. Diversification and protection.
And protection. They want to weather any storm.
Exactly. Traditional portfolios might be heavily weighted towards stocks and bonds,
Right.
but hedge funds can offer exposure to things that zig when the market zags.
Okay, but this level of sophistication, it's got to come at a price, right?
It does. And this is where things get a little controversial.
Oh, boy.
Hedge funds are known for their 2 and 20 fee structure.
2 and 20, what's that?
Basically, a 2% annual management fee no matter what happens, plus 20% of any profits they generate.
Okay, so investors are paying a premium for this expertise and these unique strategies.
Right. The idea was these hedge fund managers are financial wizards. They can consistently deliver these uncorrelated returns.
Right, they're a rock star.
Exactly. But things have changed. Fees are coming down a bit, but more importantly, there's now a big debate, even among those big institutions,
Oh, interesting.
about whether these fees are still justified. You see, the reality is not all hedge funds actually live up to that ideal of alpha. Some have become much more correlated with the stock market.
So they're behaving more like, what, a glorified mutual fund?
In some cases, yes. So you have to really scrutinize their strategy and their track record before diving in.
So there are definitely some risks involved, but let's dive into the fun part now.
Yes. Let's peek into their playbook.
Let's see how these hedge fund managers actually make their money. Professor Boyle kicks things off with what he calls the classic long-short equity strategy.
Also known as market-neutral investing. It's all about finding opportunities on both sides of the market. They go long on stocks they think are undervalued.
So they're betting those prices will go up.
Right. And at the same time, they're shorting stocks they think are overvalued.
So those prices are going to go down.
Exactly. They're hedging their bets,
Yeah.
creating a portfolio that ideally can profit, regardless of whether the overall market goes up, down, or sideways.
Okay, so that's long-short equity. What about convertible bond arbitrage?
Now that's where things get a bit more complex.
It sounds pretty complex just from the name.
It does, but at its core, it's all about exploiting pricing discrepancies between different securities. You've got convertible bonds, you've got the underlying stock, you've got regular bonds, and options.
Wow, that's a lot to keep track of.
It is, and it requires a deep understanding of how all these pieces interact.
So how do they make money?
They become experts in analyzing all those different factors that affect the pricing of convertible bonds and related securities. They're looking for discrepancies, places where they can buy a convertible bond, hedge their risk by short-selling the underlying stock, and essentially extract the value of that optionality.
It sounds like a very intricate dance.
It is. And speaking of intricate dances, what about fixed income arbitrage?
Okay, fixed income, that's bonds, right?
Right. This is where hedge funds focus on those tiny pricing differences between similar bonds.
Tiny. How tiny are we talking?
We're talking minuscule.
Okay, so how do they make money if the differences are so small?
Leverage. They use borrowed money to amplify those returns.
Ah, so even a tiny difference multiplied by a lot of leverage can become a significant profit.
Precisely.
Yeah.
But it's a high-stakes game. Requires a deep understanding of bond markets.
Okay, we've covered long-short equity, convertible bond arbitrage, and fixed income arbitrage. What's next?
Get ready for this one. Macro trading.
Macro trading, what's that all about?
This is where hedge funds make bets on global economic trends.
Wow.
Currencies, interest rates, commodities, even political events.
It sounds like they're trying to predict the future.
You could say that. Think of George Soros's famous bet against the British pound in 1992.
Oh yeah, I've heard about that.
He made $1 billion predicting that the pound would be forced to devalue.
Talk about a high-stakes gamble.
It is. Macro trading requires a ton of research, an understanding of global economics, and a willingness to take on significant risk.
Okay, from predicting global events to, well, kind of surfing market waves.
Mm.
Professor Boyle's next lecture covers something called managed futures.
Also known as commodity trading advisors, or CTAs.
Please.
They rely on quantitative models to trade futures contracts across a variety of asset classes.
So instead of picking individual stocks or bonds, they're trying to ride these big market trends.
Exactly. They might be trading futures on everything from gold and oil to stock indexes and currencies.
So they're not really worried about the fundamentals of those underlying assets.
Right. They're just trying to capture those big, sweeping trends.
So it's all about momentum, like catching a wave and riding it as long as you can.
That's a great way to put it. But remember, those waves can crash, and those models aren't always perfect.
Right, risk is always a factor. Speaking of risk, the next strategy sounds particularly intriguing to me, volatility arbitrage.
This one's all about profiting from the difference between predicted and actual market volatility.
Okay, so instead of betting on whether a stock will go up or down, they're betting on whether the market as a whole will be calm or turbulent.
Exactly. They use sophisticated models to analyze option pricing and look for situations where they believe the market is mispricing the level of future volatility.
So if they think the market is underestimating volatility, they might buy options, and if they think it's overestimating volatility, they might sell options.
Precisely. They're playing a high-stakes game with the market's mood swings.
Okay, so we've covered a lot of ground here, and we're only halfway through Professor Boyle's lectures.
It's a lot to take in, but it's fascinating stuff, isn't it?
It really is, and it gives you a whole new appreciation for the complexity of these hedge fund strategies.
Absolutely. And we've only just scratched the surface. There are even more fascinating strategies to explore.
All right, well, let's take a quick break, and then we'll dive back in and uncover even more secrets of the hedge fund world. Welcome back to the deep dive. We're ready to unravel more hedge fund strategies.
Let's do it.
Professor Boyle's next lecture is about capital structure arbitrage. It sounded super complicated.
Oh yeah, it definitely takes things up a notch in terms of complexity.
So what's the basic idea?
Well, it's all about looking at a company's entire capital structure, their debt and equity, like it's this big interconnected web.
Instead of just focusing on whether a stock's going up or down, they're looking at the whole picture.
Right, like a financial puzzle.
Mm.
They might, for instance, see a company whose bonds are undervalued compared to their stock. So what do? They buy those bonds and short the stock, betting those prices will even out.
Wow, so they need to be experts in analyzing financial statements and stuff.
Oh, absolutely. They're assessing risk, understanding how different financial instruments are connected. It's not for the faint of heart.
And if things go wrong...
That's where things get really hairy. Remember we talked about leverage. It magnifies gains, but it also magnifies losses.
Professor Boyle definitely made that point, especially with this strategy, right?
Yeah, if a hedge fund misjudges the relationship between debt and equity, or if some unexpected event happens,
Things could go south pretty quickly.
fast. Which brings us to another strategy, index arbitrage.
I think I've heard of that. It's all about finding those tiny price differences between a stock index and the actual stocks in that index, right?
You got it. Those discrepancies pop up between the theoretical value of the index and the actual market prices.
And this kind of trading is basically all done by computers these days, right?
Yeah, high-frequency trading. They use algorithms and supercomputers that can execute trades in milliseconds.
It's like the financial equivalent of Formula One racing.
Fast-paced, competitive, high-tech, a whole different ballgame.
Okay, so from super fast computers to, well, corporate takeovers, Professor Boyle takes us into the world of merger arbitrage.
One of the classics.
It sounds kind of glamorous, like something out of a movie.
Well, there are definitely high stakes involved. Whenever you've got those big merger announcements, there's an opportunity for hedge funds to jump in and make some calculated bets.
So how does that actually work? How do they profit from a merger?
Okay, let's say Company A announces they're buying Company B for $100 per share. You'd think Company B's stock price would instantly jump to $100, but usually it doesn't.
Why not?
There's always a chance the deal might fall through. Regulators, financing, maybe the companies change their minds.
So there's a built-in discount to account for that risk.
Exactly. Plus, there's the time value of money. The deal might not close for months, so investors need to be compensated for that waiting period.
Ah, I see. So the stock price might go up, but not all the way to that full acquisition price right away.
Right, and that's where merger arbitrageurs step in. They buy those discounted shares, betting the deal will go through, and they'll make a profit.
They're like deal makers, but in the financial world?
In a way, yeah. But they have to be really good at analyzing the details of the deal, understanding the regulatory stuff, knowing the odds of the merger actually going through.
So it's not just about the numbers. It's about knowing all the ins and outs of the business world.
Absolutely. And as Professor Boyle pointed out, there are two main types of mergers. You've got cash deals, where it's straightforward, cash for shares. And then you've got share deals, where the acquiring company offers its own shares instead of cash.
Things get a little more complex then.
For sure. Instead of a fixed price, you've got this exchange ratio that determines how many shares of the acquiring company you get for each share of the target company. So arbitrageurs have to consider how both companies' stocks are performing.
It's a whole extra layer of analysis.
It is, but it creates more opportunities for those who can handle the complexity.
Okay, from corporate takeovers to, well, the world of statistics, Professor Boyle's next lecture is about something called statistical arbitrage. He even said it's not really true arbitrage.
He used the example of a casino. The house always has that slight edge, right?
Right.
But people still win sometimes.
Hmm.
Statistical arbitrage is like that, finding those opportunities where the odds are slightly in your favor.
So it's not about knowing the future for sure, but about playing the odds.
Exactly. And one example is pairs trading.
Oh, yeah, like with Home Depot and Lowe's.
Right. Their stock prices tend to move together, but sometimes they diverge temporarily.
And that's when the pairs traders jump in.
They buy the underperforming stock, short the overperforming one, betting they'll eventually realign.
Betting that rubber band will snap back into place.
Love that analogy. But sometimes that rubber band breaks. The divergence might happen for a real reason. Maybe one company's having management issues or facing some new regulations. That's why pairs traders use stop-loss orders to limit potential losses.
So it's not just about the numbers, it's about understanding what's happening behind the scenes, too.
Right. Professor Boyle made a good point. Statistical arbitrage is always evolving. New models, new approaches, it's constantly changing.
Speaking of evolving, Professor Boyle's next lecture took us back to a specific kind of pairs trading, share class trades. It's a reminder that there can be multiple versions of a company's stock, each with different rights and privileges.
Yeah, like ordinary shares, preferred shares, even different classes of common stock.
They all represent the same company, but they can have different market values.
Exactly, and that creates opportunities. Share class traders are looking for those mispriced versions, betting those prices will eventually converge.
It's like pairs trading, but even more specialized.
You could say that. And Professor Boyle gave a great example of how risky this can be. The Volkswagen short squeeze of 2008.
I remember him talking about that. It sounded wild.
It was. It all started with Porsche quietly buying up shares of Volkswagen. They were aiming to eventually take control.
So what went wrong?
Well, hedge funds were short-selling Volkswagen's ordinary shares, betting the price would go down.
They thought Porsche's moves would push the price down.
Right, but they didn't realize how much Porsche was actually buying up. And then Porsche announced they controlled over 70% of Volkswagen, including shares they had options on.
Wow, that changes things.
Big time. It caused this massive short squeeze. When you short a stock, you have to buy back those shares eventually. But with Porsche controlling so many shares, there weren't enough for the hedge funds to cover their positions.
Sounds a nightmare scenario.
It was. The price of Volkswagen stock exploded. At one point, Volkswagen was briefly the most valuable company in the world, all because of this short squeeze.
Wow, that's a good reminder that even the best laid plans can go awry.
And that risk management is super important in the hedge fund world. No strategy is foolproof.
So we've covered a lot of ground. Capital structure arbitrage, merger arbitrage, pairs trading, share class trades. It's a lot to process.
It's been a whirlwind tour of hedge fund strategies. But there's one more crucial piece to the puzzle: risk and reward.
That's a great segue to our final segment. Let's wrap up this deep dive with a closer look at the potential upsides and downsides of these mysterious financial players. All right, so we spent the last couple of segments really getting into the nitty-gritty of hedge fund strategies, all those different ways they try to make money. But now for the big question. Are they actually a good investment?
Yes, the
Yeah.
million-dollar question.
The million-dollar question.
And, as Professor Boyle pointed out in his lectures, there's no easy answer. Hedge funds, they're not for everyone.
Yeah, they're definitely not for your average, everyday investor.
Not at all. They're complex, they have high fees, and the level of risk is just, well, it's not suitable for most individual investors.
He made that very clear.
hmm And even for those who do meet the criteria, those sophisticated investors, well, there's still a lot to consider.
Like what kind of things?
Well, you have to understand the specific strategies the fund is using. Really do your homework on the manager's track record.
Right, make sure they actually know what they're doing.
Exactly. And then there's your own risk tolerance. How much risk are you actually comfortable taking? Because with hedge funds, it can be a bumpy ride.
He also mentioned liquidity, right? Like how easy it is to get your money out.
Yes, that's a crucial point. Hedge funds, they tend to be pretty illiquid. So if you need your money in a hurry, well, it might not be so easy to get it back.
So you wouldn't want to put like your emergency fund in a hedge fund.
Definitely not. It's all about understanding the time horizon of your investment goals.
But even with all those caveats, those risks, there are some potential benefits to hedge funds, right?
There can be, definitely. For investors looking to diversify, maybe reduce volatility in their portfolio.
Smooth out those returns a little bit.
Exactly. Hedge funds can offer exposure to those alternative asset classes, those unique strategies that you just can't get with traditional investments.
So it's about finding that balance, right, between risk and reward.
Always. And knowing your own investment goals.
Yeah.
It's not a one-size-fits-all approach.
And I guess even if we're not all going to be managing our own billion-dollar hedge funds, there are still lessons to be learned, right?
Oh, absolutely. I think Professor Boyle's lectures really gave us a glimpse behind the curtain of Wall Street.
Yeah.
It's fascinating to see how those hedge fund managers analyze markets, assess risk, come up with those creative strategies.
It's like a master class in finance, even if you're not a professional investor.
Exactly. And who knows, maybe some of those insights will spark an idea.
For our own investment strategies, even on a smaller scale.
Right. The key is to stay curious, keep learning, and never stop questioning those assumptions.
Well, that brings us to the end of our deep dive into the world of hedge funds. I don't know about you, but I'm definitely feeling a lot more informed.
Me too. It's a complex world, but we've uncovered some of its secrets.
We've explored the strategies, the risks, the potential rewards. I think we have a much better understanding of how these financial players operate.
Absolutely. And I think the biggest takeaway for me is whether you're investing in hedge funds or anything else, research and due diligence are key.
Couldn't agree more. Always do your homework, know what you're getting into, and never be afraid to ask questions.
Well said. Until next time, keep exploring and happy investing, everyone.
And that's a wrap on another episode of The Deep Dive. We'll catch you next time for another deep dive into the world of knowledge.